This week has been an eventful one for the euro following an unexpectedly dovish statement from ECB President Mario Draghi on Thursday, while today was the last US jobs report before the September Fed meeting. Now, today's release showed that just 173,000 new jobs were created across the US economy last month, much weaker than the market was expecting. Ipek, looking at today's jobs report, would you say that a September rate hike is off the cards completely or not?
Well, nobody really knows at this stage because the US jobs data has been quite mixed. The headline NFP figure has been 173K, which has been very far from the expected 217K. However, we have seen some improvement in wages, 0.3% on month versus 0.2% expected. However, we have to mention that over the 173,000 jobs added in the US, 33,000 has been government jobs. So there is some mixed sentiment for the US data. But we have seen some irregularities in the expectations and speculations for the Fed. For the time being, after the NFP data this Friday, we can see that the sovereign markets or the pricing in the sovereign markets suggests a 26% chances for a September rate hike.
Okay. I mean, moving on to next week, on Monday, we've got a bank holiday in the US and Canada, so it's quite a quiet one. The focus on Monday, German industrial production for July. The market is expecting a rebound, is it not?
Well, actually, it is, because looking at encouraging PMI figure out of Germany this week, a correction to the latest 1.4% monthly contraction in June wouldn't be a surprise. The volatility in the stock market is still a major concern, however. DAX has given post-Draghi gains entirely this week, and the dovish ECB failed to convince traders to get back in the stock markets. So a second failure to test the 10,400 level in DAX could be a heavier pressure on 10,000 mark on the downside. Now it's all about how China will open after a two-day holiday on Monday.
Okay, so China, again, a big focus for China. I mean, we've got a few data pieces scheduled for release on Tuesday as well. What's your attention focused on in terms of Tuesday?
Well, Tuesday is going to be all about Asia. We have Chinese trade data is going to be the main focus. The further contraction in exports is what we are looking because we have seen some worsening demand in China, and the export order sub-index within the Chinese PMI has been quite bad. So we have reasons to expect some more contraction in Chinese exports. Regarding the import figures, the imports are expected to remain in deep contraction also, which is mostly going to affect the main trade partners. Australia is one of them, and the Aussie dollar has already traded below the 7-cent level for the first time since 2009 this week, and a break of the 8-week downtrend channel, which is about 169.50-60 levels, could accelerate the pace of the sell-off. So at this stage, we'll be looking very much at how Australian dollar is going to react to Chinese the slowdown in Chinese imports and exports. So the trade, the surplus or the trade deficit is not going to be the major focus, but we are going to look at the data rather separately. Besides, we have the Japanese GDP, which is expected to have contracted by a good 1.8% on quarter annualized. This is due to weaker consumption and exports, and this might revive the expectations of a further BOJ stimulus if the Fed accumulates delay on his.
Okay, fair enough. I mean, on Wednesday, we've got UK industrial production data for July. We've also got manufacturing data as well out of the UK. Would you say it's fair to say that manufacturing growth has somewhat been quite disappointing or lackluster of late?
We can say that it has, and this is mostly put on the back of a stronger sterling. But the manufacturing growth in the UK has lost its pace, but it remains on the positive path. The PMI suggests an expansion, yet a slower pace in UK's manufacturing sector, and this is, as we said, majorly put on the strong pound and slowdown in the world economy. The pound has depreciated to 1.52 against the US dollar after the payroll report this Friday, and technically speaking, we are now at oversold market conditions. A rebound could take us higher to 153, 153.50 to 100-day moving average levels, yet the fading expectations on a Bank of England rate decision should keep the upside limited, at least as the Fed speculation remain before September meeting. So we can well head down to 150, 150.80 levels, which should cool down the negative pressures on the manufacturers.
Okay, interesting. I mean, it's very interesting to see how obviously China's crisis, China's downturn at the moment is playing in terms of what central banks are going to be doing for the moment. I mean, we've got two potential market moving rate decisions coming up. On Wednesday, we've got the Bank of Canada rate decision, and we've also got the Reserve Bank of New Zealand. The markets are torn regarding the BOC, so I'm going to discuss about that first. The talk is whether they'll leave their rates at 2%, whether they'll leave their rates unchanged at 0.5%, or whether they will make a 25 basis point cut. What side of the fence do you sit on for this?
Well, actually, the consensus is status quo from the Bank of Canada. We have to be well aware of the fact that the Canadian economy is slowing on sliding oil prices. So there are some structural reforms to go through for Canada, meaning that the Bank of Canada has already reacted, putting these rates down by 25 basis points over the last months. So now it's time to wait and see how fast this is going to translate into the real economy. So rushing into more rate hike or more rate cut is not the solution for the Canada, because we are already at 0.50% and there is not much of margin left for to deal with further slide in oil prices in the coming quarters. So the market doesn't give a high probability for a rate cut, but the BOC should keep the door open for further action, because the situation is fundamentally not supportive of the Canadian recovery.
Okay, I mean, Reserve Bank of New Zealand then, I know they've said that further rate cuts are on the cards. Given recent inflation trends and the kind of slowing growth outlook, what are you expecting from the RBNZ?
So the RBNZ is going to most probably cut its rate, its overnight cash rate by 25 basis points. There's nothing surprising here. We have seen that on the dairy products exports, the volumes and the prices have been very weak. So as the Chinese economy is slowing down and their stockpiles accumulating there, I don't think that the situation is going to get anywhere better. And the only problem in New Zealand has been the house prices, but this problem should be taken care of differently than the rates. The rates in New Zealand is still relatively higher compared to the other commodity currencies, and there is for the RBNZ room for some adjustment on the downside. So 25 basis points is the most probable scenario for this for next week's meeting.
Okay, on Thursday, let's move on. We've got UK, Asia, and the US in focus, because we've got various data releases and of course the Bank of England rate decision as well. I mean, what should investors be focusing their main attention on for Thursday?
Well, the Chinese inflation is going to be the main focus and is expected to have accelerated to 1.9%. The producer prices could plunge more, with a target estimate of 5.5% contraction. There is no piece of new information here. The Bank of China has the margin to act and is already acting by loosening its policy and also acting by direct interventions. The route in Chinese markets may not be over. The market needs to find a solid bottom first before thinking about a new tentative for recovery. So Shanghai stocks have more potential on the downside. Unfortunately, all the air seems to be not taking out yet. Regarding to the BOE decision is going to be a non-event. We expect the BOE to sit on its hands, because we don't have more clarity from the Fed, and most of the analysts and the market is not giving any probability for a rate hike before the year end. It's mostly going to be pushed to 2016 first quarter, or maybe even the first half. So on this inactive or inaction from the BOE, we might see once again sterling losing a little bit more ground against the euro and the dollar, especially the dollar, and 150 levels could be the new midterm target for the pound sterling.
Okay, brilliant. Ipek, thank you ever so much.
Thank you.
That's Ipek Ozkardeskaya there with the week ahead. Join us next time, but for now, goodbye.